Welcome to another real estate industry update. I'm your host, Daniel Raconti, here with Kyle Paxton, part of the real estate segment at James Moore. These are exciting times this month of May. The big tax proposal just popped out from the House Republicans on their new tax bill that Trump and the Republicans have been talking about. And so today we're going to go over what the proposals are. There's 400 pages of this, so we're only going to go over the very high parts, the ones that matter, especially to real estate. But there's some favorites in here, like 100% bonus depreciation that everyone loves. So looking forward to getting to that and kind of just going over the high ends here. Do realize this is the proposal. This still has to go through the Senate, get approved by Congress. This is going to get changed, but we can at least go over what kind of the first draft proposal is. All right.
That's a heck of a hook, Daniel. This is one big, beautiful video about one big, beautiful bill. So let's get into it. This is May 14th we're recording here. So as Daniel said, subject to change at any time. I think a lot of the big ticket items we're going to talk about will end up sticking, but just keep that in mind as you're watching.
That's right. And the one big beautiful bill, I don't know who names these, but these are great names. Like it's either someone spent a lot of time getting the name for this, or someone just like thought of it in 5 seconds, and everyone was like, "Yeah, that's good." But kind of big picture, what is going on with this whole bill? All right, the whole point is that Tax Cut and Jobs Act that passed under Trump in 2018, it's set to expire in 2025. Most of this provisions are either to make it permanent from the Tax Cut and Jobs Act or to temporarily increase it probably to about 2029 is what it sounds like. All right. So through Trump's presidency, and then the next president's got to figure out what they want to do with the whole tax thing after that. The aim,
Rinse and repeat. It keeps us employed over
I
here.
know, right? Like every 4 to 7 years, they're just always pushing it off. They're guessing right now the whole is to kind of lock this down by July sometime, so it could actually come around pretty quickly on us. Will that actually happen? We don't know, but hopefully we'll have a bill here and it'll get passed and we'll know what to do in 2025 here in a couple months. All right. As always, real estate is always front and center in all of these tax reform bills just because of all the great benefits that real estate provides. So let's go into like the key changes for real estate people in this bill. The number one that everyone loves, I mentioned it already, bonus depreciation, it's back to 100%. Okay. If you don't remember, it was 100% for a long time and then it slowly dropped by 20% every year. So 2025, under the current law, it's at 40%. All right. This is another 60% increase, get us back to 100%. Now, this is for some reason applies to property bought after January 19th, 2025. If you don't know what January 19th is, that's when they swear in the new presidents and stuff like that. So not sure all the rules about that, but there's going to be 19 days there where you're still only going to get 40%. So that's kind of interesting. But for most of the year, back to 100%. So this is great for all you cost segregation people out there, anyone that's doing short-term rentals or just buying multifamily, things like that. I love this. I was always worried a little bit about cost segregations coming up if the bonus didn't come back. They're still effective. They're just not as effective. This is just going to really front load, accelerate that depreciation when you get soft cost segregation, which really gives you that return on investment.
Absolutely. And I want to stick on this for another second because I think it is really important in talking about tax planning and things like this. Regardless on how this bill ultimately shakes out, I personally think 100% bonus depreciation will be back, right? And so, in planning your cost segregation timings and things like that, keep in mind that, as Daniel mentioned, through the first 18 days of 2025, potentially you have a much lower or bonus depreciation percentage than bounce to 100%. So we are in May 2025 here, but if you're looking at any 2024 as you're filing your 2024 tax returns and finishing those things up, things to keep in mind in terms of timing of deductions and things like that. There's a lot of planning around that. And the other point I want to make on this is real estate professional status makes bonus depreciation, just takes it to a whole nother level of benefit. We have videos on that in this video series and the interplay between, your activity level in businesses and the deductibility of expenses and things like that. So be sure to check this out.
Yeah, super happy about the bonus depreciation, and it actually has bipartisan support. So the Republicans, because they control Congress, are the ones that propose this bill. But this one instance of bonus depreciation, bipartisan support, a bill does have to get passed. A lot of things could change. This is one that nobody thinks will actually get changed. Another one that I was kind of surprised about. I mean, they have talked about it, but I didn't think it actually happened. Is basically boosting 199A, or more commonly known as qualified business income. Okay, this is basically a potential up to 20% deduction on business income. Rental properties and things like that qualify this for this deduction, just like trade or business income does. They're talking about increasing it from 20% to 23%. All right.
It kills my back of the napkin calculations to make sure we're getting the full 20%. 23% is so much harder to eyeball.
What for tax professionals and CPAs that pay your tax,
My life is harder now,
this
I'm
is
just
a
saying.
nightmare, but for the taxpayer, this is great. I mean, it's just 3% extra savings now. I mean, this is gonna make all your pass-through income, your real estate income, things like that. It's just a little bit less taxes you have to pay. So nobody who pays taxes hates paying less taxes. So this is great for all of this. And it
And just to clarify, that it makes it such that you're basically just paying subject to
right.
limitations, that you're paying tax on 77% of your business income, so
Right. There's
that's
still going to be
important.
limitations in here, such as W-2s and qualified business or property, basically. So this is like your real estate, your basis, and your real estate, things like that. But this is another great one. One other key topic that's been talked about a lot is the SALT deduction. Just a little history on it. Basically, you used to be able to itemize the taxes that you paid and start state and local taxes. Then when it came out Tax Cut and Jobs Act, they capped it at $10,000. Okay. So people that are in high paying tax states like New York, California, were very upset about this. But even honestly, here in Florida, we see it from a lot of our own clients because,
Oh, yeah.
I mean, property taxes have gone up significantly. It's very normal to pay over $10,000 just in property taxes. And then on top of that, if you're in real estate, and you might be doing real estate outside the state of Florida. So now you got to pay taxes in other states too for all your real estate profits. And guess what? Now those get limited to $10,000 as well. Um,
Basically, every tax return I see now is limited to
right.
$10,000 on there,
Everybody,
yeah.
everyone is limited $10,000. So there's been a lot of talk about this. Now this was the one that out of everything is going to change the most. Okay. This one was very like, yeah, this is our proposal, but they basically were just like, there's still going to be a lot of talks about this. They're trying to initially what they're doing is they're going to lift the cap from $10,000 to 30,000. Okay, it's nice. It's not great, but it's still nice. But then it phases out for people with income over 400,000. So you get the increase. That's like, okay, well, this is kind of defeats the purpose because the most people who are getting advantage of this are going to be people making over $400,000. Okay, we expect this to actually change probably pretty dramatically. The cap will probably be over 30,000. I'll be interested to see if there's actually an income threshold or if it's not significantly higher. This one's going to change a lot, but do know that it's in there, and this is probably going to at least get increased. We just don't know how much yet. Another interesting thing they mentioned in there, kind of a workaround that a lot of people have been doing, is the pass-through entities. So if you have basically a business like a partnership or an S corp, you can pay those state taxes on the actual business return as the business entity. And so instead of it flowing through and getting itemized, you actually have a business deduction for it on the federal return. There's a lot of mentions in this bill, basically trying to make PTs go away. They states found a way, a workaround basically on this. Well, I'll be interested to see what actually happens, but I'm not sure if they can just make it go away overnight. But there's either the increase in the lift of the actual salt deduction, and the fact that I think the state government or the federal government did not like the PTEs, and they just unfortunately under the law they couldn't prevent it. I think this bill is going to basically try and prevent that. We'll see if they're successful at all. But hopefully they'll list the salt deduction and it won't even matter anymore. The other huge one that was talked about is the estate tax exemption. Okay. This was going to go away after 2025. It's going to get cut in half. So this will be raised or basically stay about the same. It'll be $15 million per person, so $30 million if you're married, and that'll start in 2026. So basically, it's not getting cut in half. This increased state is great for real estate people because of how much real estate has appreciated, especially over the last
Oh,
5
yeah.
years. and everything. We thought we were going to have significant estate problems for a lot of our clients. It's like I said, $30 million for a married couple, but if it had did not change, it was going to get cut back and it was only going to be about $15 million. It's still a lot of money.
Big thing.
It's still
Yeah.
a lot of money, don't get me wrong, but there's a lot of clients out there that own really grade A, class A real estate that's worth $15 million, 15, $20 million. And that creates a huge estate problem because they don't have a liquid asset to pay for the inheritance tax when they pass away and they give it to their kids. So increasing this was a big deal outside of bonus depreciation. It was probably the next biggest thing out of this bill.
Totally agree.
And every attorney is probably happy because they were going to be doing to do a lot of planning in 2025. This makes it so that it's not like a rush to get everything done by 2025. All right. And other things that are kind of interest here, they mentioned opportunity zones again. They're trying to renew opportunity zones and enhance it. So that means newer opportunity zones. So areas that were not an opportunity zone might be now. And they update it for this current market because it was done back in 2018. Well, a lot changes in 5 years. And then they're going to try to enhance it. Things that were not mentioned in this bill, though, was that original gain that you deferred, it's still due in 2026.
Coming.
It's still coming. There was
Yeah.
no mention of deferring that. We were talking about getting an extension, doing something. There's no mention of it. It doesn't mean that still won't happen, but unfortunately, in this current wording of the proposal, there's no mention of that. It's still you get your step up basis after 10 years of the investment. There's also, if you remember originally, if you originally invested back in like 2018, you would get like a small 15% deferral. There's some mention in there about maybe bringing that back for people that invested in these before the original, after I think it was 2021 is when it phased out completely, basically. There's some mention in there. So they're looking at enhancing these, but the original talks, unfortunately, that you're still going to have to pay that original deferred tax due. So don't be expected that you're going to keep delaying that one. But they didn't have a lot of information on this one. I'd like to see how this one actually gets played out. Another one is Section 179. That cap increased. They're increasing that again. So this kind of goes with bonus depreciation and things like that. If it's 100% bonus depreciation, we usually don't worry too much about Section 179 because you're always going to take bonus. But Section 71 just lets you potentially expense the capital asset if you can't fully depreciate it. So they were talking about increasing that. Just these are more possible deductions that increase all those capitalized assets that you have. These are great for like furniture and equipment, but you can sometimes 179 things like HVACs that you can't bonus depreciate. So there is some on the real estate world that there's certain things there that are going to benefit you.
Yeah, 179 becomes way less significant when bonus is back at 100%. We're spending a lot more time in 2024 tax prep looking at 179 given the lower bonus depreciation thresholds, but that does even out some as 100% bonus comes back.
So
179 can be a little more nuanced. So
right.
good.
Another thing to kind of just quick mentions here, this bill had a lot of focus actually on rural and even agriculture areas. They're really trying to beef up benefits to invest in rural areas. And so it's not just opportunity zones in the middle of the city. They really want to start investing in rural areas. So they're talked about an interest exclusion in rural areas. They're talking about expanding the low income housing credit, a lot of benefits, expanding the opportunity zones to more rural areas. So I think they're really trying to incentivize basically real estate investment in more rural areas. So
Yep.
there's a lot of mention in that. This one there we need to get more detail before we can really get into what.
And the opportunity zones do play into that as well. Again, it's just incentivizing investments in certain areas. So we're seeing that come through in a number of areas in this bill.
Right. A big one, and it's not really real estate related, but anyone who knows about R&D credits are some of the best tax credits out there. But unfortunately, there's this weird thing that they made you do where instead of being able to expense your research and experimental expenditures, you had to instead amortize it. This fixes that problem. You go back to deducting it instead of amortizing it. Anyone who's getting an R&D credit is overwhelmed here. And any tax preparer who has to do this for their client is much happier now. We don't have to go back and amortize it. So that's a pretty big deal with the R&D credit out there. It doesn't as it's not as much for real estate people, but it is big just in the tax world in general. There's a lot of talks about no taxes on tips. So this bill also mentions that they're going to try not to have tax tips and overtime. That one was an interesting one. You're working overtime. We're not sure how the details are actually going to work out there. For real estate people, it probably won't matter as much here, but you still have employees, you still have things like that. I just realized there is some stop talks in here about basically tips and overtime just being exempt from taxes. So that's nice. Another really interesting one, not so much real estate related, but there was a talks about getting auto loan interest deduction. So just like how you can get a deduction right now on your mortgage on your primary residence, now you can do that for autos as well. This is again, it's going to be for US manufactured vehicles because that's kind of what the whole thing with this administration is. But there probably be some kind of auto loan interest deduction there for people who are buying vehicles. It will be people who buy vehicles probably in 2025, so it won't be if you're paying interest on a current loan, but this is another way to kind of incentivize people to keep buying vehicles and US made vehicles.
And I do believe, if I'm recalling correctly, that that's above, both above and below the line in terms of, I don't think that's included in itemized deductions in the initial draft of the bill, but it's deductible whether you itemize or take the standard deduction.
Right. And just to go over a little few other things, this is trying to permanently increase the tax rate. So the highest tax rate of 37%, they're trying to make that permanent. Okay. Technically right now is supposed to sunset and go back to the old one, which I think was 39.6%. So this will keep the same tax rates. They're trying to expand their standard deductions. They're trying to even do a senior bonus. So people over the age of 65 will get an extra deduction. There's a lot of little things in there. There was even mention of a 529 plan expanding what qualifies. So now, like business exams, entrance exams outside, even post college are now eligible. So, hey, CPA exam, if Kyle and I know it's expensive and time consuming. So now you can use 529 plans. So there's a lot of other things outside of even just real estate that these are talking. But unfortunately, anytime you have a bill like this, it is going to create a huge deficit. And so they have to offset it somehow. Okay. So how are they offsetting it? There's some talks in here about basically making Medicare and Medicaid or more stricter, things like that, putting more of the cost back on states. Same with SNAP or food stamps, more commonly known, bearing more of the cost basically to states. There's a lot. The one that's mostly tax related though is all the green energy programs that kind of came out during Biden. So this is more like solar credits, e-charging credits, the home energy efficient credits. So there's a lot of those tax credits that are basically going to go away. Okay. The good news though is we do not touch the really good energy credits that most real estate developers will be using, such as the 179D deduction, the L45 tax credit, those basically all the investment tax credits like that. Those are not being touched. Those all the real estate investors and stuff will still be able to use those, but they are basically trying to kind of claw back.
You're gonna make a cut somewhere.
Yeah,
Yeah.
they got to cut somewhere, and so they're clawing back a lot of these credits, and that's kind of the way to do it. So just be aware of that. That if you're doing any home energy efficient stuff, and you were not able to get a nice tax credit, you might not be able to anymore. And if you're doing solar, that's a big one for I think a lot of people. I'll be interested to see how that goes. But solar had some nice credits if you were wanting to do that and invest in it because it's pretty expensive and they're clawing all that back. All in all, I mean, this is a pretty good bill, Kyle. I'm gonna say for real estate investors.
As a real estate accountant, it makes me happy.
No, I would say this is a win. The things that mattered the most to real estate, they got 100% bonus, the estate tax exemption increase, just lower tax rates, and then they didn't, they all the great things that you love about real estate, they either boosted or they just kept the same. So no touch of like-kind change, no touch to cost segregation outside of you getting the increased bonus deductions and things like that. So I think everything that real estate wanted was in this bill, and they didn't take anything away. The green incentives, I don't think it's going to be that big of a deal because the big ones they still left in there for all the big real estate developers and things like that.
There will be tweaks from the Senate and 75 more adjustments to this, but round one looks good for our real estate folks.
Yep. So just keep that in mind. There'll be a lot of changes, but we wanted to bring this out to you guys as quickly as possible to get you an update. So solid win here for real estate. Hopefully we will have this bill passed sometime in July, and we'll know the actual details. Then Kyle and I will come out with another episode with what it truly was passed and how to get ready basically for your tax planning here in 2025. So thank you for tuning in to today's episode. We hope you found our discussion insightful and valuable. If you enjoyed this episode, please subscribe as we produce frequent videos related to real estate. Join us next time for more expert insight and tax strategies to help you maximize your real estate investments. Till then, stay informed, stay proactive, and happy investing.
Have a big, beautiful day. Take care.
To learn more about James Moore & Company's real estate accounting and business solutions, go to jmco.com. And don't forget to subscribe to our Real Estate Industry Update series to receive updates when new videos are released. If you'd like to be a guest, or if there's a topic you'd like to see covered on a future episode, contact us through our website or email us at info@jmco.com. You can also follow us on social media for more news as the landscape of real estate continues to rapidly evolve.